video, I'm going to answer your questions. Any questions you have, this can be about investment, finance, anything coronavirus related, economy related, better understanding of owners' earnings and begin to use it yourself and evaluate companies yourself.
How to think in probabilities, not certainties. And that's essentially what you have to do as investors.
Today I'm going to show you everything about owners' earnings, how to calculate it, why it's so important, what goes into it, why it's one of Buffett's favorite metrics to use, how I use it to evaluate every single company I look at.
Talking about specific value investing concepts and techniques.
We're going to talk about why you must read company financial reports and why you cannot just rely on the numbers. Hey, Jason here. Today's Free Training Friday video, we're going to cover what the cash flow statement is, why it's important, and what's important to look on it. Before I get to that though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, iTunes, Stitcher, SoundCloud, Anchor, Spotify, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. Okay, so in the last couple weeks, we've covered what the income statement is, what's important on it, what the balance sheet is, what's important on it. Now we get to the third and final financial statement that is available from public companies. Frankly, this is most important. After you get kind of past the initial margin of safety check on the balance sheet, the cash flow statement is where I spend most of my time looking at. Be warned, this video may be broken into 2 or 3 parts depending on how long this video goes, and I do expect this video to go longer than the other 2. I think the other 2 combined were like 20 or 30 minutes long. So if this gets very long, I'm going to break it into multiple parts as well, because there's a lot to cover. Again, this is the most important statement I look at. Before I get to my explanation and my kind of training on the cash flow statement, I want to give you the book definition of what it is and explain to you what that means. Okay, so here we are on Investopedia, and this part is what we're going to cover right here, or in the intro, at least in this intro section. So the statement of cash flows, or the cash flow statement, is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving a company. So this is more straightforward, frankly, than most of the definitions I share on Investopedia of the book definition of what these things mean. But still, what does that mean? Essentially, what the cash flow statement is it shows the cash running through your business, what you start with, what you end with, and how you got to that point. That's what the cash flow statement shows. The reason this is so important is because it shows what cash you started with, what you ended up with in whatever period you're looking at. Usually it's a quarter for public companies. Could be monthly for a private company. How you got to this final number, where you started, where you ended, and how you got to that final number. The reason this is so important, again, is because you want to know what the cash flow is doing in your business. Business isn't built on share prices or speculation or emotion like what we're seeing in the coronavirus times we're living right now, with extreme speculation and emotion driving pretty much the entire market. That's in the short term. That is what drives the short term, or the market in the short term, even when you aren't dealing with a crisis. Over the long term, though, companies are based on the profits they produce and the cash flows they produce. So that's why this is so important, because if cash flows go up over time, the value of the company goes up, the share price goes up. If it goes down, same thing, or it's the reverse of that happens. Value of this company, or of the stock, goes down, value of the company goes down. So that's why this is so important. Now, let me bring you to my main screen here to get you, there we go, to get into the explanation of this. So I've got up Microsoft. Again, I'm just using Microsoft as an example because everybody knows who Microsoft is. To get to the cash flow statement, go to the Financials tab. When it comes up, sorry, I apologize for this. Anytime that I share my screen or record my screen, it takes a while to load, so I apologize for the slight delay here. go to quarterly. You always want the quarterly numbers. The only time you pretty much want the annual numbers is when you're comparing year-to-year periods. You always want the quarterly numbers. They pretty much always have the most up-to-date information. Even if the company just released their annual report, the quarterly report will show the most recent information. To find out and learn about the income statement and the balance sheet, those will be linked as resources below this video, or the previous videos in this series talking about those statements will be linked below this video in the resources section. But go down here and go to the cash flow statement. Scroll over. Okay, so let's close everything out to make things less confusing, because we're about to open up a huge amount of tabs, as you'll see, and I'll try to explain everything as best I can. Again, if this video gets long, me and my team may break it up into 2 or 3 videos. So look out for those videos as well if you're still watching the first video, but you want to see the other parts and it gets cut off. Okay, so the cash flow statement starts where the income statement ends. So the income statement ends with net income. This is where the cash flow statement starts. So here is the income or loss before non-cash adjustment. Again, as I've explained in these other videos, Morningstar recently updated their database, or probably a year ago now, at least updated their database, and they don't always word things as well as they definitely don't word things as well as they should. This is the net income. I don't know why they just don't put net income or net profit or net earnings here. This is net income. This is where that starts. So in the trailing 12-month period, Microsoft has earned $44.2 or $44.3 billion rounded up in net profit. Then from here, this is where things get a little bit crazy. So total adjustments for sorry, it's not coming up here, non-cash items. So for any definition that I don't fully explain, you can either look it up on Investopedia or join the list below to get my resource doc on where I explain information on what some of these terms mean in a real world sense. And you can get that for free along with 4 other gifts. But if I do not explain one of these, either look it up on Investopedia, Google, but I would try to explain everything as best I can, which again is going to take a little bit, which is why this video could get broken up. So non-cash items, keep that in mind as we go through this. So depreciation and amortization, these are typically combined on the cash flow statement. These are things like depreciating off the value of land, property, plant, and equipment off the balance sheet, amortizing payments, amortizing things off the balance sheet. Typically, this, again, is based on what the company owns and or produces. Because if the company owns hard assets, some of their inventory over time could be depreciated or amortized. Typically, again, that's a write-off or an impairment if that happens. But typically, depreciation and amortization is for things like buildings, equipment, stuff like that, land, stuff like that. They, by law, have to be depreciated off the balance sheet over an XYZ amount of time. Again, it varies. Things like land and equipment, or land and buildings, are typically 30 or 40 years. Vehicles are 5 years, and other equipment like computers and other stuff kind of fall in between that. But this is a charge. When this happens, or it's not a charge, we'll get back to that in a second. But so this is not, it is a non-cash adjustment. The reason it's non-cash is because this, when you have to do this for accounting purposes, it doesn't affect you in terms of your cash flow. You don't have to pay this amount out from your monthly cash flow. This is for essentially tax purposes and accounting purposes only. This is why it's called a non-cash adjustment. Stock-based compensation. Again, you don't pay this out of cash typically, unless it's a stock award. These are most likely things like options being awarded to people that they can exercise at some point in the future. But again, it's an expense, but you don't have to pay it out as cash right now. This, again, is an expense, but it's not cash, which is non-cash. Again, this is, I hope I'm explaining this well enough. If I'm not, let me know in the comments below, and I'll try to explain things better. But this is why the cash flow statement is intimidating to many people, because there's so many different things you need to know on here. And typically it's on each line you need to know different things. Taxes, again, these are, I'm not really sure why these are in the non-cash adjustment, because you have to pay these out. I don't know if these like are prorated taxes. To find out for sure, we'd have to go into our financial statements. Then, okay, so let's close this out. Oops. Don't close this out. We're not there yet. Net investment income. So again, these are not cash unless you sell the investment outright and take it out of your brokerage, for example. But these are gains and losses on investments. So let's say a company wanted or owned a subsidiary company or even a stock portfolio like Warren Buffett at Berkshire Hathaway. This is where a huge chunk, he gets dividends from those payments, or he gets dividends from any of those stocks. Even when he doesn't sell, that would go in here. If he does sell, that would go in here as well. Okay, so now we close this out. So these are all the things we just talked about that are considered non-cash charges. Changes in operating capital. So here's where we get to some of the operational cash flow. Change in inventories. This means the company bought more inventory than it did in the previous period, or it did not buy as much inventory as it did in the previous period. Similar thing here, change in trade or accounts receivable. The company did more business and it got paid more, or expects to get paid more in the future right here, or it did less than that in the time before. Changes in payables. So these are things like paying for equipment or services or something at some point in the future that you have to pay for, that are not operational, or that are not things like operating leases. Okay. And this gets us to net cash flow from continuing, I think it's operating activities, indirect. So this includes a wide range of things. This includes how the company, what it got from its investments, what it did with its inventories, what it did with its accounts receivables, payables, the difference in these over time, and what they did in the quarter. So in this quarter, for example, it was a positive $18.7 billion in total net cash flow from continuing operations. Continuing operations part of it means the operations that are ongoing at the company. Again, even whether they're non-cash, like up here, oops, or things from investments, or things directly from operations. So here's from investing activities now. So this was operations up here. This is from investing activities. Purchase or sale of property, plant, and equipment. Purchase, sale of businesses. These are acquisitions. Purchase, sale of investments. This is, again, like the investments we talked about earlier. The other ones, again, we'd have to figure out why these were considered non-cash above here by going to their actual footnotes. But just on Morningstar, this is their kind of real world profits or losses from investments. So this is how much they purchased. This is how much they sold. And this is the net number right here. Okay, this to me, this is all important. Seeing the change over time from their operations and their investing activities, super important. All of it. This is the most important section though of the cash flow statement to me, because it shows you how much cash they raised from issuances, or net cash they raised from issuances and payments. Issuances and, let's see, issuances of stock or payments for stock, like they're buying back stock. Sorry, again, I don't know why this doesn't say buybacks instead of payments for stock. Issuances or repayments of debt, because this will show you if where the company is getting its money from. If it's not getting it from operations or investing activities, typically you want to see the company generate most of their cash flow from operations, because that means the operation is not only running well, but that it's profitable and that it can continue to sustain itself and the entire business without having to issue debt and shares. The reason this is most important right now down here is because many companies during this coronavirus crisis are not producing as much cash flow from operations, or they're producing negative cash flow from operations. So they're having to issue debt or issue shares to raise cash to just stay alive. This proceeds from issuance of common stock. So they issued, what are these numbers in? Billions. So 0.34 billion. So 340 million proceeds from issuances. That's likely because of the small amount and the size of this company. That's likely like stock option conversion, stuff like that, or stock-based compensation. This payments for common stock. So they bought back about $6 billion, just under $6 billion worth of stock. Over time, in the last 12 months, they've bought back almost $23 billion in stock. Again, I'm going to have another series about stock buybacks and why they're important. But typically, you want to see people buy back stocks when the stock is undervalued, because it increases the value of the overall shares. Again, if you want that information, I'll link that video below this for more information on why that's important. But this section right here is super important. So this is the net right here. Tracked. Oops. This from this, and you get this. So they bought back, they spent $21 billion, $0.6 billion in cash to buy back whatever, how many ever shares that was. This, and I don't know why this keeps doing that. There we go. Okay, repayments of long-term debt. This is, they spent $5.5 billion on repaying debt. Again, typically you want companies to pay down debt. The only times you really want companies to take on debt is if they can do it at a super low rate and they have high cash flows already, so they can service the debt and they can use the debt to grow faster or buy back shares or research and develop, or to go to research and development, whatever, to grow the company. Again, most companies right now, due to the coronavirus, this is reversed. So this would be 5 billion in issuances. This would be, and this would be zero. If a company has to buy back or has to issue debt or shares to stay alive, A, it's unsustainable because the company won't be able to do that for the long term. At some point, the ability to use your stock or debt markets to continue to essentially finance your company is going to run out. B, it's not an optimal way in most cases to run your business. Again, in most cases, you want your company's operations to produce enough cash flow that essentially you can run your entire business just off that if you need to. Which is another problem we're having with today with the closures. Companies are having much lower cash flow because they're not operating, so they don't have operating cash flow. So that's another reason companies are having to issue debt and shares at frankly, an enormous rate that's going to end up badly at some point in the future. So right now, today, as of this recording, this entire thing is important. This entire statement is important. This right here is the most important to me right now during this coronavirus crisis. This also shows the dividends that you paid out. And the change in cash. Again, I don't know why they changed this. It used to be on the old Morningstar site. This used to be a lot simpler up here, this entire statement. And it used to say just free cash flow easily down here. So this change in cash in the last 12 months minus the effect of rate changes does not equal that. It equals this. So this is the free cash flow number. Again, I don't know why they do this here. I don't know why they just don't say free cash flow here. But that is what the free cash flow number is. Again, change in cash as reported, supplemental. So this is after this is what that means, the supplemental. So everything on here is important. Again, typically some top tips of mine to read this because, again, I've been doing this for years, almost 14 years now. If you want to learn how to read a financial or a cash flow statement better, you literally need to go through hundreds of these to see what happens over time. So an example that I would be doing right now is, so this in its entirety right here, these are the last 12 months right here, equals this. But how does this compare over time? So this is where I would bring in the annual statement. So let's start down at the bottom so we can see what their cash flow has done over time. So right now it's higher than it was in 2016, 2017, 2018, or 2019 probably. Yeah, 2019. And only lower than 2018. Typically, you want the free cash flow amount to be going up over time, obviously, because that means the cash has more free cash flow, which, again, as we talked about at the beginning of this video, is how the value of the company grows over time. What you also want to look at is free cash flow to sales metric, which I'll bring up over here. You find this by staying on the quote tab. And then again, when this loads, apologize for the delay. right, I don't know why it's asking me to sign up for an account. There we go. Go to Key Ratios tab. Scroll down to cash flow, and this number is one of my favorite investment metrics. This tells you the free cash flow divided by sales over time. Super important. You typically, again, want to see this going up over time. I look for anything about 5% on a consistent basis. So Microsoft just destroys that threshold. So even though it's fallen a little bit, or quite significantly actually from 2012 to today, it's not a huge deal because Microsoft produces an enormous amount of cash flow. You can see the absolute numbers over years here. And you can see the free cash flow here. Or free cash flow per share, sorry. If you want to look at an easier to understand, this is how the, right here, this is how the free cash flow statement used to look like. It would go into some detail on the numbers that we just went over, but essentially it would talk about these. And then at the end, it would say free cash flow. So another way to look at free cash flow is just go here. So on an absolute basis, free cash flow is actually up about $21 billion since 2011, even though its free cash flow to sales margin has gone down. I'm going to bring you back to my screen. There we are. Okay, so that is the cash flow statement. Again, confusing on the one look. If you don't understand what the terms mean, frankly, I mean, you need to understand what the terms mean. I'm a big believer in the fundamentals of evaluating a business and value investing, and think you need to know what the terms mean so you can understand what everything means just by looking at, for example, one metric, the free cash flow to sales metric, what goes into that, why that's important, everything to kind of get to that bottom number so you can spot where there's going to be problems. Because again, right now, with everything we're seeing in the coronavirus and business shutdowns, business slowing down enormously, you're seeing cash flow from operations fall significantly, and you're seeing cash flow from financing go up significantly. You don't typically, again, you don't want to see that. You want to see cash flow from operations sustaining the business. Now we're seeing a lot of cash flow from financing sustaining the business, which is not sustainable over the long term. You don't build the value of your business over time by issuing shares and issuing debt. You build it from the operational value of your company. Again, in the short term, I understand there are issues that come up, and there's ways to optimize this. Like Apple for years has used, even though it doesn't need debt, it issues debt at super low interest rates because it can, to buy back shares and to fund a dividend and to fund R&D. In that case, it's good, but that's Apple, and they're also worth $2 trillion. So that doesn't work for most companies, especially over the long term. So especially when your business is shut down and you're seeing far fewer customers, because the big problem you get into then if you issue more and more debt is you can't pay the debt. Then you go bankrupt. That's, again, what we're seeing a lot today. So I hope this made sense. I hope I explained things well enough. If I didn't, let me know in the comments below. If I missed something, let me know in the comments below. Again, I tried to keep things as simple as possible. But to be honest, the cash flow statement is confusing on first look. But once you understand what everything means and all the pieces and parts mean, then you can just use the free cash flow. Unless you're looking for something specific, then you can just look at the free cash flow production on the key ratios tab on Morningstar to get the information like that, instead of having to parse through and close tabs and see what happened. Again, I still do that for every company. But if I'm just looking for the final free cash flow number, I'll just use the key ratios tab. If I'm looking for specifics, then I go to the financial statement, which is what we just went over. So hope everything made sense. If it didn't, again, let me know in the comments below. If you're watching on YouTube, make sure to like, love, share, subscribe, and comment, and hit the notification bell so you're notified every time we release a new video. And we're releasing new videos all the time. If you're listening on the podcast, like, love, share, subscribe, comment, download, all that good stuff. And we really appreciate a review, because the more reviews we get, the more views we get on our content, the more listens we get on all of our content, the more people we can help. If you want some more information specifically on what the terms mean, or some of the terms mean, you can get the Value Investing Journey glossary of terms for free, as with 4 other free gifts to learn those terms and what they mean in a real world sense, for free by entering your email address below. And until next time, I'll talk to you again soon. Have a great day. Bye.